Hello and welcome to Livewire's Buy, Hold, Sell. I'm Ali Selby, and it's no secret Australians love a bit of bang for their buck. Perhaps that's why so many of us gravitate towards the market's dividend darlings. According to Bloomberg, over the past financial year, the ASX 200 generated 60 billion in dividends for investors. So in this episode, we'll be talking about 6 Aussie players set to supercharge their dividends over the months ahead. I'm joined by Plato's Don Hamson and Margolis from Merlon Capital. First up, we have Westpac, which analysts believe is set to return 8 to 10 billion to shareholders over the coming months. I'll start on you, Don. Is it a buy, hold, or sell?
Right now, from us, it's a hold. We do like the banks, and we do think they'll be increasing their dividends, but we'd probably put a couple of the others ahead of Westpac at the moment, so it's a hold from us.
Neil, it has an annual yield of around 3.6%, but its share price has been down around 17% over the past 5 years. What do you think? Is it a buy, hold, or sell?
Look, it's a buy for us. Just putting it next to CBA is very stark. It's got similar levels of surplus capital, say 8 to 10 billion, similar franking, but its market value is 90 billion and CBA is 180 billion. So it's quite extraordinary. That one of the reasons it's a lot cheaper is because they've lost control of their costs. So they do need to get the costs under control. They've had much more management turnover. But putting that all aside, I think there's a big opportunity to take cost out, and the dividends look pretty safe to us. At a sector level, I had a look today. The 4 major banks spend $36 billion a year on costs, which is roughly the same as Afterpay's valuation. And I'm not sure which number actually astounds me more.
Okay, let's move on. Next up, we have Aurizon Holdings, which is Australia's largest rail freight operator, with a nice dividend yield of around 7%. Neil, I'll stay on you. Is it a buy, hold, or sell?
No, that is a buy for us. It's a bit out of favor because they do haul coal, and China's trying not to buy coal at the moment, and coal has also got some environmental issues. I would note 70% of their coal is met coal, not thermal coal, which is used to make steel alongside iron ore. They've got a monopoly rail track, which is quite low risk, and they've got very manageable debt levels, and they generate fantastic cash flow, which is why Warren Buffett always liked railroads. So it's a buy for us.
As you mentioned there, coal hasn't been the flavour of the month, or the year for that matter, with Aurizon's share price suffering as a result. Don, over to you. Is it a buy, hold, or sell?
It's a buy from us too, because we do think the price is too cheap, way too cheap. It's been affected by the sentiment on coal. Agree with Neil. It's a good, solid business, great cash flow, great yield. So it's a buy from us. And you are seeing coal prices come back very strongly. So we like Aurizon.
Don, I'll stay on you. Speaking of coal, next we have BHP. It's got an annual yield of nearly 4%. Is it a buy, hold, or sell?
It's a buy from us because we're very bullish on the iron ore prices. There'll be some big dividend increases from BHP. Remember, it's also got copper assets, and potentially it's looking to sell its oil and gas, which I think will make it look a lot more attractive from an environmental perspective. So great yield, great business momentum at the moment, making a fortune out of iron ore and not bad out of copper too. So it's a buy from us.
It's set to report on August 17th. Should investors expect a cash splash? Neil, over to you. Is it a buy, hold, or sell?
Look, it's a sell for us. Fantastic company, very low cost production, but iron ore's gone from about 35% of the group's earnings to about 70%, and the iron ore price, while incredibly high, is 8 times the cost of production. So it only costs $25 to produce iron ore, and it's selling for $200, and it's not called a commodity for nothing. So normally supply does catch up. There's also a risk that demand moderates. I agree with Don, fantastic dividends this reporting season, no problem at all. I just think, the share price could come under pressure if iron ore, starts moving towards the cost of production. It's a long way to go.
Last up, we have Old Faithful Telstra, which has a dividend yield of around 4%. Neil, I'll stay on you. Is it a buy, hold, or sell?
Look, Telstra's a sell for us. I think they're paying 16 cents, so they should probably, the sustainable dividend, I think, is only around 8 cents. There's still lots of unsustainable elements to their earnings from the, obviously, government payments, from copper, still a few copper earnings. It's possible they could gouge more on the mobile side and make more money there. That is one upside risk. But standing away from the detail, the company has almost $15 billion in debt. So it's got a market value of equity and debt of close to 60 billion. and it generates about 3 billion in pre-tax earnings, and it could generate less. So it's a sell for us.
Telstra hasn't been that kind to shareholders over the past few years. Its share price is down around 33% over the past 5. Don, over to you. Is it a buy, hold, or sell?
It's a buy from us at the moment. I understand what Neil says, but they're actually making some good pricing decisions in their mobile. Just actually got a great price for selling half of their towers, and they're going to return that capital to shareholders in one form or another. So for us, it's a buy actually, but it's probably more a trading buy than necessarily a long-term buy.
Okay, Don, we've asked you to bring along a stock that you have high hopes for reporting season and beyond. What have you brought for us today?
Well, no surprise, I like iron ore, and Fortescue is a pure play, and we expect some great dividends out of them. In fact, they're trading on a huge yield already, but we expect with the dividend increase, it's going to get even better. But even now, it's trading on a historic yield of 15% when you include franking. So that's incredible. Yes, there are risks on the iron ore price, but it's going to deliver a very good result and a great return of cash and franking credits to shareholders.
Neil, over to you. Can you beat FMG? What stock do you have high hopes for in reporting season and beyond?
Look, we have bought New Hope Coal recently, which is a smaller coal mining stock. It's the old Wesfarmers Bengala mine, which is very low cost. It's actually $10 a ton less than BHP's cost. It has $500 million of surplus franking credits, and the coal price has actually also doubled. It was a bit late to move, but it's also doubled recently. And unlike iron ore, it reflects more broad-based global demand recovery, whereas iron ore is very much dependent on what China's infrastructure plans. So we do think it's on a massive cash flow yield. Look, we fully support decarbonization. We actively engage with the company to not expand their mines and to wind them down orderly over the next 10 years. But it is high quality, low cost coal. And where the coal price is trading, the company is on 2 times cash flow. So again, we don't expect the coal price to stay at these levels, but every month it does, the company is paying off debt with $500 million of surplus franking. We actually expect a pretty good dividend.
Well, there's definitely upside on the horizon, but you just need to know where to look for it. But we'd also like to know what you think. Let us know what dividend darling you are backing in the comments section below. That's all we have time for today. We hope you enjoyed this episode of Buy, Hold, Sell. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding new content every week.